guys, it's Jen Conley, and today we're going to go over some of the acronyms that you may hear when you're looking for a house, kind of the beginning process that you'll hear some of these things kicked around and people talking about them, and I thought that would be a good thing to explain to you so you kind of know where we're coming from when we say these things. So the first one is FHA. That's the Federal Housing Administration, and that is who governs a lot of our loans. So we get a lot of our guidelines from there. We can go to them for help. It's actually part of HUD, which is Housing and Urban Development. So they're kind of under that canopy, and we can go to them for help to get loans done. They also then insure the loans after closing. That way, if we have any issue that, God forbid later on down the road someone default, there's an insurance there to cover the lender. APR, that's the annual percentage rate. And those are fees that are associated with doing the loan. Those are fees that you wouldn't have if you paid cash. So it then gives you it looks like an interest rate, but it's really not an interest rate. It has nothing to do with your payment. It's a way for you to compare loans with the costs of loans, not just the rates. ARM, this is an adjustable rate mortgage. So typically you will have some sort of fixed time, usually 3, 5, 7, or 10 years, and your payment will stay the same there. But after that, your payment can adjust. Now, during the crash and all the crazy stuff that people have heard me talk about in the past, some of those loans were not great loans, but they were also used improperly. This can be a really, really good loan if you know that you're going to move a lot. It's a really great loan for veterans that get stationed in various places and sell their homes. So there are uses for this loan that are really, really good, but it's kind of gotten a bad rap over the last 10 years or so. So we can actually look at your situation and see if it's something that would work for you. The rates are typically lower, which then makes your payments lower. So it's a good product in that aspect. But you have to realize that we just have to look at your situation to see what works for you. Most people, the 30-year or the 15-year fixed is the best option, but this is a good option for some of our clients. LTV, that's loan to value. So this is probably used more with refinances. You'll hear someone say your 85% loan to value is all you can borrow if you're taking cash out, or you can do 96.5% loan to value if you're not taking cash out, and that's for FHA purposes. But what that is how much loan versus the value. So if you have a house that's worth $100,000 and you borrow $80,000, you've got an 80% loan to value. Now on a purchase, loan to value really doesn't come into play. Our sales price is where we start. So if you're buying a house at 80%, if you're buying a house at $100,000, then that's where our bar starts. The appraisal doesn't determine where that starts at. It starts with our sales price. PMI, that's a dirty word for a lot of people. It's private mortgage insurance. And I think that people need to look at this a little differently. So it is an insurance policy that you pay on the buyer's behalf, pays it for the lender, and that protects us if there's ever a default where you go behind or you foreclose, and it will pay us a portion of our money back. So lots of buyers don't want to pay that. You'll hear agents say you don't want to have PMI, but you really have to look at that differently. If you're doing FHA, USDA, those have PMI on them regardless. And what that does is it really allows you to buy a home without putting 20% down. So it's really not a bad thing. It's also tax deductible. Now I'm not an accountant, but it is tax deductible. So you just need to really look at how you're framing it. If you don't have 20% down, this gives you the ability to get into your dream home without that. And in the old days, that just wouldn't have happened. You would have had to have had 20% down. So it really is a good thing. It's just kind of gotten a bad rap over the last few years. And VA. This is the Department of Veterans Affairs, and they work with us to do loans for our local veterans. And it's a really great product. I know you guys have heard me talk about it a lot. You can do 100% of a purchase price. You can do high limits on cash out. So it's a really, really great product. What they do, much like FHA/HUD, they then guarantee the loans after closing. So if something were to happen, they then give us our money back. So it's a really great product that doesn't have monthly mortgage insurance. It does have a funding fee if you're not disabled as a veteran, but it's still a really, really good product for our veterans, and it's something that they've earned their eligibility with during the process of serving our nation. So those are kind of the acronyms that you'll hear prior to getting into contract on a house. We'll do another video that are the ones that you will hear during the process. But these are the ones that you most commonly hear. You're going to see on mortgage blogs. You're going to see, you know, when you Google something, these are going to pop up. And I just thought it would be good for you to have an explanation. So if you want to go a little further into this and you want to know more about it, give us a call, 740-851-4760. You can apply online at 851-4760.com. You can find us on Facebook at Home Loans by Jen, or you can always come into the office here locally at 52 East Main Street and see us to get started today.